Good afternoon, and thank you for joining us to today's webinar, Actionable Guidance from the latest Opportunity Zone Regulations. I'm Bob Sharon, partner and tax practice leader, and I have more than 35 years of public accounting experience working with high net worth individuals, family groups, and a range of businesses spanning multiple industries. My primary focus is enabling Freedman's tax department to efficiently assist clientele with tax planning and compliance needs to sustain and increase their assets. Joining me today is Stephen Bocaius. Steve is a partner and qualified Opportunity Zone consulting practice leader. He specializes in advising prominent real estate organizations that are involved in a wide range of properties. Steve also brings extensive experience to the financial arena. And also joining me today is Michael Greenwald, partner and corporate and business tax practice leader. Michael has more than 35 years of experience in public accounting. He has served clients in a variety of industries, including financial services, technology and media, manufacturing, wholesale distribution, private equity, real estate, construction, and professional services. Michael is the chair of the Partnership Taxation Technical Resource Panel for the American Institute of Certified Public Accountants. Freedman is a leading provider of accounting, tax, and business consulting needs of public and private companies going back to 1924. We are consistently ranked among the top 50 accounting firms nationally and have ranked among the best places to work throughout the accounting industry and all regions where we operate. Freedman is dedicated to helping clients maximize their tax position and uncover opportunities in light of sweeping tax changes resulting from the Tax Cuts and Jobs Act. Since the creation of qualified opportunity zones under the Tax Cuts and Jobs Act, the excitement surrounding this powerful new investment tool has been palpable. With a new set of IRS guidelines and the clock ticking for investors to take advantage of potentially one of the biggest tax breaks in decades, now may be the time to act. Today's presenters will provide a brief overview of the Opportunity Zone program, what we know now in light of highly anticipated newly released guidelines, and what we're seeing from our clients, including a case study and key takeaways. At the conclusion of today's webinar, we will attend to questions from our listeners. You can submit your questions and communicate with us throughout the course of the webinar using the chat box feature on the lower portion of your screen. We would also be delighted to schedule time to speak with you one-on-one to better guide you on your particular situation. Now, at this time, I'm pleased to turn the presentation over to my colleague, Steve Bocaius, who will kick off the program, which will be divided into 4 parts. First, a brief overview of Opportunity Zone funds, then a discussion of the latest proposed regulations, third, what we are seeing with our clients and a case study, and finally, key takeaways. Steve?
Thank you, Bob. We'll start with an overview of what exactly is an Opportunity Zone. An Opportunity Zone is a low-income community at its basic level. The designations were chosen by the states and certified by the U.S. Treasury back in the spring of 2018. There are over 8,700 Opportunity Zones in the United States, constituting 10 to 12% of the entire country. So, I mean, in terms of the land mass, it's an extensive amount of an extensive area. The Opportunity Zone designations are good for 10 years through December 31st, 2028, at which point the zones will be redrawn. The designation is intended to incentivize the movement of capital and investment into these low-income areas to develop property and promote and expand businesses and jobs. So the tax benefits, what are the tax benefits of investing in Opportunity Zones? The tax benefits are two-pronged. First, there's a temporary deferral of capital gain recognition through December 31st, 2026. Secondly, and in some respects more importantly, there's a permanent exclusion of post-acquisition appreciation in the Qualified Opportunity Fund investment as long as the investment is held for at least 10 years. So what that means is if someone, say, were to invest $1 million in a Qualified Opportunity Fund, hold it for 12 years, sell it for $1.5 million, that full $500,000 of gain would be permanently excluded from federal and in most cases state tax. In regards to making the initial deferral, anyone who makes an investment into a Qualified Opportunity Fund can defer the gains to the extent that cash up to the amount of the capital gain is invested in the fund. There's a permanent exclusion for a portion of those deferred gains, provided that certain holding period requirements are met. In terms of investing cash into a qualified opportunity fund, an investor has 180 days from the deemed realization date to invest cash up to the amount of the capital gain into the fund. The gain is deferred until the earlier of December 31st, 2026, or the time in which the taxpayer disposes of his interest in the fund, if that is prior to the 2026 date. There's an exclusion of the portion of the invested capital gains. If the qualified opportunity fund investment is held for at least 5 years, 10% of the deferred gain is permanently excluded from tax. So to use the old example, if somebody were to invest $1 million of capital gains into a fund and held the fund for at least 5 years, 10% of that gain would be permanently excluded from tax. So $1 million of deferred gains were invested, $100,000 is excluded. On December 31st, 2026, the remaining balance of $900,000 would be taxable.
Steve, when you say it will be taxable, at what rate will it be taxable? It'll be taxable at the rates in effect in 2026, or at the rates, today's rates?
Based on the guidance, it'll be taxable at the capital gains rates in effect in 2026. Currently, those rates are 20% for long-term capital gains and potentially another 3.8% if those gains are subject to the net investment income tax. In terms of the initial holding period, if the investment in the fund is held for at least 7 years, 15% of the initial deferred gain is permanently excluded from tax. The last year to make that investment is 2019, because the 7-year holding period would have to be met by December 31st, 2026. So to use the example, if a taxpayer today were to defer $1 million of capital gains and invest it into a qualified opportunity fund, $150,000 of those gains would be permanently excluded, and the $850,000 balance would be taxable on December 31st, 2026 at the rates in effect at that time. Now, the character of the gain carries forward. If a taxpayer defers short-term capital gains, holding the investment for 7 years doesn't age that into a long-term capital gain. So that's a very important point. If short-term capital gains are deferred, short-term capital gains become taxable 7 years from now.
And Steve, it's clear that it can only be capital gains that are invested. In other words, if I have ordinary gains from the sale of a property, say depreciation recapture, that can't be invested in an opportunity zone to get the benefit?
That's correct. When the guidance was first released, some people thought that any gain could be deferred, but the first set of proposed regs made it clear that only capital gains are eligible for deferral. The main benefit of the Qualified Opportunity Fund, obviously deferring capital gains is beneficial, but the tax ultimately becomes due to the extent of 85%. But there's a permanent exclusion of appreciation in the gain in the investment as long as the investment is held for at least 10 years. So today, in 2019, if I invest $1 million into a Qualified Opportunity Fund and I sell it in 2030, I would have held it for 11 years, and any gain on that sale would be permanently excluded from federal tax and from most state taxes. So that is a very large benefit of investing in these funds. So just to recap, the benefits are two-pronged: the deferral of capital gains, which become taxable in 2026, and the permanent exclusion of appreciation as long as the 10-year holding period is met. The benefits of qualified opportunity funds only apply to the extent that deferred capital gains are invested. So let's assume that a taxpayer invests $1.5 million into a qualified opportunity fund. Let's assume that $1 million of that constitutes a long-term capital gain, and $500,000 of that is fresh cash. What happens? It's okay to invest in excess of deferred capital gains, but the benefit, which is the 10-year exclusion which is the exclusion of appreciation after 10 years, only applies to the extent that deferred capital gains are invested. So in our example, if I invested $1.5 million, of which only 2/3 represented deferred capital gains, and I sold that investment, say for $2.5 million, of that $1 million gain, only 67% would be excluded after 10 years. The balance, which is attributable to non-deferred capital gains, would be treated as a normal investment and would be taxable.
Steve, suppose I put in borrowed money, or suppose I borrowed money at the fund level or at the Opportunity Zone business level, as opposed to putting in another $500,000 in terms of cash equity. Does that same rule apply?
No, it's very taxpayer friendly. If a fund uses leverage, that leverage is not considered to be a non-qualified investment. So let's assume that a fund buys a building for $1 million, puts $200,000 down and borrows $800,000 and sells that building in 15 years, say at a profit of $1 million. The full profit is excluded, even though 80% of it is debt financed.
So in other words, I'm incentivized to borrow money in my fund or in my Opportunity Zone business, as opposed to putting in just real cash.
That's correct. And as we previously indicated, only capital gains can be deferred. One thing to keep in mind, people tend to assume that the sale of real estate is a long-term capital gain, assuming that the holding period is met. That's not true to the extent that there's 1245 ordinary income recapture, or to the extent that a taxpayer has 1231 losses over the past 5 years, which convert some of those gains into ordinary. So if a taxpayer sells real estate, it's dangerous to assume that those gains can automatically be deferred. The taxpayer would have to look at his specific situation to make sure that at his level, those gains will in fact be treated as capital gains.
Steve, does that apply only to real estate, or is it really any property that's any depreciable assets that are used in a trade or business?
That would apply to any depreciable assets.
So if I sell a piece of equipment, for example, at a profit somehow, same rules apply.
That's right. To the extent part of that gain is converted into ordinary, the ordinary piece cannot be deferred. Flow-through entities. Either the flow-through entity, such as a partnership or an S-corp, or its partners or shareholders can elect to defer the gain and invest into an Opportunity Zone fund. The method for doing it is very simple. If a partnership, say, elects to invest into an Opportunity Zone fund, the K-1 reported to the partner does not reflect the capital gain. So the partner has no capital gain to defer. It's already been done. If the flow-through entity doesn't elect to defer the capital gains are reported on the Schedule K-1 and then can be deferred by the partner. So from a reporting perspective, it's very straightforward. For partners, shareholders, beneficiaries of flow-through entities, the 180-day period for investing these gains begins on the last day of the flow-through entity's taxable year. So let's assume that I'm a partner in a partnership and I receive a 2018 K-1, which shows $1 million of capital gains. And let's assume that that capital gain was incurred by the partnership in March of 2018. It doesn't really matter when the partnership incurred that gain. From my perspective, my 180-day period started on the last day of that partnership's taxable year, which is December 31st, 2018, and I would have 180 days from that date, or June 28th, 2019, to invest those gains. You know, let's assume that I knew about the gain and I knew that there was a great qualified opportunity fund that I wanted to invest in April of 2018, but I knew I wasn't getting my 2018 K-1 until March of 2019. What could I do? I could make an election to use the partnership's realized date at the beginning of my 180-day period. Of course, that requires coordination with the partnership and can't necessarily be done automatically. In terms of the operation of a qualified opportunity fund, there's a 90% asset test, which the fund has to meet every 6 months. So what does that mean? At least 90% of the qualified opportunity fund's assets have to be qualified opportunity zone property. Qualified opportunity zone property is defined as qualified opportunity zone stock in a C corp or S corp, qualified opportunity zone partnership interests, or qualified opportunity zone business property, and we'll discuss exactly what that means. These tests are every 6 months, and 90% of the assets have to be qualified opportunity zone property. One thing to keep in mind, if a qualified opportunity fund owns nothing but qualified opportunity zone stock or qualified opportunity zone partnership interest, then 100% of its assets are deemed to be good assets, and it would have a 100% ratio. Cash, a question that we get a lot. What if I'm sitting on cash? You know, I have a 90% asset test to meet. Is the cash a good asset? At the qualified opportunity fund level, cash is not a good asset. The fund cannot hold more than 10% of its assets in cash. However, there's a working capital safe harbor for qualified opportunity zone businesses, which we'll define. It's a subsidiary partnership, which effectively holds the assets. And as long as the qualified opportunity zone business has a plan that identifies the cash as being held for a project, and there's a written schedule for deployment of the cash within 31 months, the cash is considered a good asset. So effectively, the qualified opportunity zone fund structure would have 31 months to deploy the cash, you know, for acquiring, constructing, or rehabilitating tangible business property or developing a business. What is qualified opportunity zone business property? It's property that has to be acquired by purchase after December 31st, 2017. I get a lot of questions by people saying, well, I've had these assets for 10 years, but they're in a zone. Can I use them? No, they're not good assets. Either the original use of the property has to commence with a qualified opportunity fund, or the qualified opportunity fund has to substantially improve the property. So what does it mean to substantially improve the property? It means that the investment in the property has to be doubled by the fund within 30 months. So to give an example, if I buy new equipment and that equipment has never been used in the zone, I'm done. Once I purchase the equipment, there's nothing more to do. If I buy a building that existed in a qualified opportunity zone and that building is not brand new construction, I will have to rehabilitate that building to double my investment in that building within 30 months. One thing to keep in mind on a building acquisition, the land is carved out from the building, and only the portion of the purchase price allocable to the building would need to be doubled. Some clarifying points. The original use of the property has to begin with a qualified opportunity fund. Used property can be purchased. As long as that property was not previously used in an opportunity zone, the investment doesn't have to be doubled. I only have to double my investment. I only need to rehabilitate the property if it was previously used in a zone. So what does that cover? It primarily covers buildings that are already in the zone. Those have existed, that investment has to be doubled. If I'm buying brand new equipment that obviously was never used in the zone, if I'm buying equipment that was used outside the zone, I can bring it into the zone and not have to double my investment. So that's a very important clarifying point.
Steve, you mentioned that the business has to be used within the zone. It gets a little confusing. Let's say I set up a distribution center and I've got all kinds of trucks, but the trucks are going outside the zone to various causes. Will that still qualify if the hub is in the zone?
It depends. We'll discuss that further. 50% of the gross income has to be generated in the zone. So either 50% of the hours have to be in the zone, or 50% of the payroll has to be allocable to work done in the zone. So the answer to your question is it depends. There is a safe harbor which may cover you, but the hours safe harbor and the wage safe harbor may or may not get you there. So we talked a lot, and I made references to a qualified opportunity zone business. What exactly is it? It's a subsidiary partnership or corp that's owned by the Qualified Opportunity Fund that holds the assets. It has to have been acquired at original issue after December 31st, 2017 for cash. And it has to meet the definition of a qualified opportunity zone business, which are having substantially all of its tangible property within the zone. But only 70% of the assets have to be in the qualified opportunity zone. So right there is a benefit of a qualified opportunity zone business. Notice that a qualified opportunity zone fund needs to have 90% of its assets in the zone. A subsidiary qualified opportunity zone business only needs 70%. At least 50% of the entity's gross income has to be derived from the active conduct of the business, and a substantial portion of the intangible property has to be used in the active conduct of the business in the zone. Less than 5% of the assets can be cash unless you meet the working capital safe harbor, And there are certain businesses which are taboo, which include private or commercial golf courses, country clubs, massage parlors, hot tub facilities, racetracks, gambling establishments, or liquor stores. Those are taboo businesses which would not qualify. And now we're going to move on to the latest proposed regulations, which were issued in April of 2019, just a few months ago, and they expanded upon and addressed many of the unanswered questions that remained after the initial guidance, and the first set of proposed regs came out in October of 2018. One taxpayer-friendly development in the new set of proposed regs is that qualified opportunity funds can hold cash for longer periods of time. A lot of questions I get is that, what if I'm right before a testing date and I get a slug of new cash? More than 10% of my assets are going to be in cash in the fund. Is that going to blow up the asset test? The answer is no. Under the proposed regs, a qualified opportunity fund can ignore any contributions received within the past 6 months when applying the 90% asset test. That means that I could get cash, say on June 27th, ignore it at the June 30th asset test, and just need to deploy it before December 31st. Second, another question I got, what if my qualified opportunity fund sells an asset and is sitting on cash? Will that blow up my asset test? The answer is no. A qualified opportunity fund has 12 months to reinvest the cash from the date of sale. Keep in mind that it's the qualified opportunity fund that has a 12 months, and it's a qualified opportunity fund that can ignore cash contributions for 6 months, not a subsidiary qualified opportunity zone business. So that's something to keep in mind when all of these tests are being reviewed. Original use. A common question that I would always get when the guidance came out is, what if I buy new construction? Theoretically, I'm buying it from the builder, so I'm not the original user, the builder is. Would I have to double my investment? I can't do that in new construction. There's nothing to double. More taxpayer-friendly guidance under the proposed regs. The original use is defined as a point in time when the property is eligible for depreciation. So if I buy a new building, I'm the first one who can depreciate it. I'm deemed to have original use. I don't have to double my investment in the building. So that means that a qualified opportunity fund or business can acquire a property in a zone that's already been built, but is first placed in service by the fund or the zone. Also, if a building has been abandoned for the past 5 years, the original use is deemed to initiate with a qualified opportunity fund or the business, and the investment would not have to be doubled. Though from a practical standpoint, I would expect that if a building has been abandoned for 5 years, it's probably going to need some work.
So Steve, if you buy a building, does the buyer have to do a cost segregation study?
The buyer could do a cost segregation study and write off the personal property. You could run into tax basis limitations. Mm-hmm. When an investor defers gains and invests them into the fund, their initial tax basis is 0. So it's possible that you could be in a position where those losses are temporarily disallowed and carried forward until there's basis. If there's a debt allocation in a partnership structure, it's possible that that would allow enough basis to deduct those losses, but it's an analysis that would need to be done every year.
Sure.
The treatment of land. A lot of questions center around the treatment of land. What happens if I'm sitting on an empty lot? Well, an empty lot in and of itself isn't good, because these rules are designed to promote investment in low-income areas, not for somebody to warehouse land and then flip it in 10 years at a profit. So empty land has to be used in a trade or business. If the land isn't being used as part of a trade or business, there has to be a plan to develop it substantially within 30 months. That doesn't mean someone putting a shack on it and saying, I've developed it. So from a practical standpoint, a parking lot around a building is fine, because that's really used in the trade or business as part of the building. But an empty lot only qualifies if there's a plan to develop it. Another taxpayer-friendly move, there's an extension of the 31-month working capital safe harbor. It's been expanded to include developing a business from scratch Based on the original guidance, it wasn't sure if that applied or not.
Steve, can I just go back to your land thing for 1 minute? So if I pave the land and paint stripes on it to park cars, is that considered improved?
I think if you build a parking lot garage, that would be considered improved. If you're just paving the land, that may not be considered a substantial improvement.
Okay, suppose I go out and buy those lifts for cars. So now I can park cars, I've got a bunch of those, mechanical lifts that'll let me park 2 or 3 cars high in each space. Do you think that's enough?
I think at that point you have a viable trader business. You've invested capital. I think that would be enough.
Good, thanks.
So there are 3 extensions of the 31-month working capital safe harbor rule. These are very important. As I previously said, it's extended to developing a trader business. So while you're developing a trader business, you have 31 months to deploy the cash, buying equipment, leasehold improvements, things of that nature. We've all run into governmental delays, and some people were concerned that because of governmental delays or bureaucratic delays, they wouldn't be able to deploy the working capital within 31 months. To the extent that the delay is a result of governmental inaction, the 31 months is extended. Another question is, what if I get multiple cash investments that are staggered? How does that play into the 31-month rule? Each cash investment has its own 31 months. So if I get a cash investment in January and I get another cash infusion in June, the 31 months is tracked separately for each infusion. Another question that has come up is, if an investor defers capital gains, what would cause that capital gain to be picked up prematurely before December 31st, 2026? And effectively, it's reducing your equity interest in the Qualified Opportunity Fund, which makes sense. The reason why a taxpayer got the deferral is because they invested in the zone through the fund. If they reduce their equity interest, then part of that deferred capital gain becomes taxable to the extent of the equity reduction. The proposed regs have an extensive list of transactions which would cause an inclusion of part or all of the deferred capital gain, which include, as you would expect, sales of the interest in the Qualified Opportunity Fund, or sales of an interest in an S Corp or partnership that's a Qualified Opportunity Fund investor. So it's not a direct sale of the Qualified Opportunity Fund, but it's the sale of a vehicle that holds the fund, and gifts of the Qualified Opportunity Zone interest. So if I'm an investor in a Qualified Opportunity Fund and I gift that to somebody, that would actually cause an inclusion of the deferred capital gain. Another common question is death. What happens if a taxpayer dies while holding a Qualified Opportunity Fund investment? And the answer is death does not restart the holding period. It does not cause an inclusion. The 5- and 7-year basis step-up holding periods and the 10-year inclusion holding periods are not restarted. Those carry forward to the beneficiaries. The transfer of an interest to a grantor trust that's disregarded is not considered an inclusion event because for tax purposes, a grantor trust is a disregarded entity. Another common question, especially in real estate, is what if a Qualified Opportunity Zone fund refinances a building and then distributes some of the refinancing proceeds? Is that okay? And the answer, based on the second set of proposed regulations, is generally yes. As long as a taxpayer in a partnership has enough outside tax basis to absorb the distribution of cash, then the cash can be distributed without any negative tax ramifications. Similarly, dividend distributions from C corporations are not an inclusion event unless the dividends exceed basis. And in terms of the basis rules, something to keep in mind, an investor has a zero basis in its Qualified Opportunity Fund interest on day one, assuming that all they did invest are deferred capital gains, gets 10% of its basis after 5 years and an additional 5% after 7 years, and then gets a full basis on December 31st, 2026 to the extent of the deferred gain because it's been picked up. An investor in a partnership receives tax basis for its share of underlying debt. So that goes back to what we were talking about before. If a Qualified Opportunity Fund is invested in real estate, finances it, a taxpayer can actually draw against that debt and be considered to have basis to cover the distribution. The way the original rule was written is that in order to exclude the gain after 10 years, the qualified opportunity fund interest itself had to be sold. The fund itself couldn't sell the property, and from a real world business perspective, that could create a lot of problems because it's a lot easier to sell a building outright than it is to sell a privately held partnership interest. So the proposed regs have a solution to this problem. The proposed regs say that if an investor has held an interest in a partnership or an S Corp, notice how it says partnership or S Corp, not C Corp, for at least 10 years, the investor can elect to exclude from gross income some or all the capital gains from the qualified opportunity fund's disposition of qualified opportunity zone property. There's a similar provision for holders of REIT stock. So what this means is that as long as I've held my partnership interest for over 10 years, if that partnership sells property at a gain, a qualifying assets that are a capital gain, I can elect to exclude the gain. It doesn't matter that I'm still holding an interest in the qualified opportunity fund. So then what happens on the flip side? What happens if I've only held my partnership for under 10 years, for 8 years, and then the partnership decides to flip property? What happens? Unfortunately, the normal tax rules apply, and I'd be paying tax on that gain. So even though a qualified opportunity zone fund can sell assets, hold the cash for 12 months, and reinvest, there's no provision which says that the investors don't have to pay tax on that gain. The investors are only able to exclude any gains to the extent that they meet that 10-year holding period. Another thing to keep in mind is that this 10-year asset sales election for sales of property only applies to partnerships and S Corps. It doesn't apply to C Corps, and it doesn't apply to the subsidiary qualified opportunity zone business, which means that the qualified opportunity fund has to be allocated the capital gain, which is then passed on to the investor. Another big area that the proposed regs expanded upon was the treatment of leased property. A common question is, can a qualified opportunity fund or qualified opportunity zone business lease property? The answer is yes, provided certain conditions are met. First, the lease has to be entered after December 31st, 2017. And substantially all the properties used has to occur in an opportunity fund for substantially all the time that the business leases the property. And the lease must have market rate terms. So it's okay to lease property from an unrelated party. The question then becomes, can a fund lease property from a related party? And the answer is yes, but you wouldn't necessarily want to in certain cases. Certain conditions have to be met. The first is the fund, the qualified opportunity fund or the qualified opportunity zone business can't prepay its lease payments beyond 1 year, which is fine. That's not really a major thing. The second point can make it unattractive. If the lease property is tangible personal property, then the property must either have its original use with the fund or the qualified opportunity zone business, which effectively means in a lot of cases it has to be new property. Or if it's used property that was already in the zone, the qualified opportunity fund or business must purchase tangible property that meets the qualified opportunity zone business requirements and will be used in an opportunity zone. What does that mean? It means that if I lease property from a related party that was already in the zone, I have to buy property at least equal in value to that leased property within 30 months. So then the question becomes, why would I do that? And the reason for this provision is that there's a concern that funds may try to avoid the substantial improvement requirement by leasing the property from a related party. What this is saying is, if I lease tangible property from a related party that was previously in the zone, within 30 months, I have to buy property at least equal in value to the property that I'm leasing. I think in a lot of cases, that's going to be a non-starter. They're active conduct of a trade or business requirement for qualified opportunity zone businesses. The entire point of this provision is to generate business within the zone. There was a question as to whether rental real estate was considered an active trade or business. The proposed regs make it clear that it is, but not in the case of triple net leases. A qualified opportunity zone business is required to derive at least 50% of its gross income from the active conduct of a trade or business within the zone. So what exactly does it mean? What does it mean to generate 50% of my gross income from the active conduct of business within a zone? What if I basically have an Amazon-like deal and all my customers are throughout the world, not in the zone? How would I satisfy that gross income test? Well, there are three safe harbors. At least 50% of all the hours of employees and independent contractors working for me have to be within the zone. Well, that's a good thing. It means I could have people working in my warehouse and we could ship things throughout the world and we'll meet the test. Or 50% of all the payments for services are performed by employees and independent contractors within the zone. Well, that's a good thing too. I can ship things throughout the world, and as long as my employees are concentrated in the zone to the extent of 50%, I'm in good shape. There's also a facts and circumstances test. If the tangible property of the business is in the zone and the management or operational functions performed in the zone are necessary for the generation of at least 50% of the gross income, that's a facts and circumstances test, and it would be on a case-by-case basis to determine whether it was met. Intangible property. A qualified opportunity zone business has to use a substantial amount of its intangible property within the zone. So that could be software that was developed. What exactly does that mean? It wasn't defined in the guidance or in the first set of proposed regs. The second set of proposed regs define it. Substantial is defined as 40%. So that's not really a lot. It means that a qualified opportunity zone business has to use 40% of the time, the intangible property has to be used in the zone. So there's really a lot of leeway with that test.
Steve, did they give any guidance as to how you measure the use of intangible property? I mean, how do I know what 40% of my patent time used is, for example?
Surprisingly, no guidance was given on that. But I would imagine that if, majority of your employees are in the zone, a majority of your wages are in the zone, you could probably get to the point that a majority of your intangible property is being used in the zone. But again, that's not a sure thing. A big thing that was in the proposed regs, generally to defer capital gain, cash up to the amount of the deferred gain has to be invested. What if somebody has property that they want to invest? That's okay too. So if I realize capital gains of $1 million and I want to defer that $1 million, I don't necessarily have to contribute $1 million of cash. I can contribute property into the fund. And how is that measured? It's the lesser of the property's tax basis or the fair market value. So it's the lesser of the two. So if I contribute property with a tax basis of $600,000 and a fair market value of $800,000, that would allow me to defer $600,000 of capital gains, assuming I had realized $600,000 of capital gains to defer. To the extent that I contribute property in which the fair market value exceeds the tax basis, I'm deemed to have two investments. One investment is the amount of deferred gain equal to the tax basis. The second investment is the excess of the fair market value over the basis, which is considered a non-qualifying investment, and I wouldn't get any benefits for that piece. So when I sold the opportunity fund, say in 12 years, a quarter of my gain would be taxable because a quarter of my initial investment was not qualifying, didn't defer capital gains. 1231 gains, very prevalent in real estate and even the sale of a trade or business. The proposed regs indicate that flow-through entities cannot defer capital gains. They have to be passed up. The investor is required to use the last day of his tax year as the start of the 180-day period for measuring. The investor has to use the last day of his tax year for the start of the 180-day period. Why is that? Because unlike sales of stock, An investor's 1231 gains have to be netted against their 1231 losses. So it's only the net 1231 gain that can be deferred. On top of that, to the extent there's any 1231 loss recapture from prior years, converting it to ordinary, that cannot be deferred, which is why even if you sell real estate in the middle of the year, the 180 days doesn't start until the end of the taxpayer's taxable year.
So Steve, if I've got a real estate trader business and I'm going to sell my property in 2019, you're effectively telling me that I've got to make my qualified opportunity zone investment on 12/31/2019 in order for me to take advantage of both a 10% and 5% basis exclusion. If I wait past 12/31/19, even though that's the measurement date for my 12/31 gain, if I wait even a day into 2020, now I'm no longer eligible. I can't meet that 7-year holding period, so I'm not going to get the 5% exclusion.
That's correct. So in that situation, if a taxpayer really wanted to get the full 15% exclusion, they would really have to know in advance and quantify what their net 1231 gains are going to be for the year, and to ensure that there's no 1231 loss recapture, converting some of it to ordinary.
So can I set up my own qualified opportunity zone fund so that I'm ready to go on 12/31/19 and I can throw the money into it?
Yeah,
Start the clock?
Correct. The fund can be set up and it can be funded on December 31st, 2019. There'd be nothing to prevent that from happening.
So if I know I've got a deal going down now, I should set up my own fund and just have it sitting there waiting for me on the shelf.
That's true, or a third-party fund that you're ready to invest in.
And you can self-certify that fund that you set up.
Correct. Carried interest. There was hope that carried interest would be considered qualifying investments for the performance of services. They're not. Unless cash or property is contributed to a fund to defer capital gains, there's no benefit. We're now going to move into a client case study, what we're seeing in the marketplace. Our clients are leaning towards the formation of proprietary opportunity zone funds. Some of our high net worth individuals are investing in third-party funds by some of the major brokerage houses, but a lot of them, especially those that are very real estate savvy, are forming their own funds to invest in real estate. Some of the funds are being financed entirely by family money. Other funds are being seeded with family money, but open to third-party investors with the family maintaining control. Everything I have seen so far is focused on real estate acquisition or development of commercial residential properties. I have yet to see any of my clients form an actual operating business, such as a restaurant or retail. Everything that I've seen has been real estate focused. In terms of the structure, most funds are forming a two-tier structure in which the qualified opportunity fund owns a qualified opportunity fund business, which actually holds the asset. And we'll get into why or what the thought process is for making that decision. One of our clients, for example, formed a qualified opportunity fund with proprietary and outside investors to buy an old warehouse site. The site's going to be completely renovated, but the fund is going to sit on a large amount of cash, which is going to be used for the renovation. Well, in that case, cash isn't a qualified asset, so what do? You basically have to form a qualified opportunity zone business, a subsidiary partnership, to hold the cash and deploy it within 31 months to meet the working capital safe harbor. In this case, there was no choice but to use a two-tiered structure. If the two-tiered structure wasn't used, the fund would be at risk of failing the 90% asset test because of the amount of cash that was going to be on hand.
Steve, could that client have waited to pull down the cash? Or it couldn't because the investors needed to park their gains now?
The investors needed to park their gains. They had realized the gains. They wanted to defer them. So if the fund didn't pull down the cash right away, the investors wouldn't have been able to defer the gains, and the fund would not have gotten the money.
So there's a real tension in the way these deals are structured between the needs of the investor. I've got to put my money in 180 days after I generated my gain, and the needs of the business, well, I don't need the money yet, and then the stringent requirements of the regulations as to who can and can't hold that cash and have it be a qualifying asset.
That's right.
You know, speaking of those stringent requirements, and there are many, if you violate them, what happens? Does the capital gain immediately become, you got to pay the tax right away?
Based on the guidance, there's nothing which would cause the investors to have to pick up their deferred gain. There is a penalty that the fund has to pay, which is based on the difference between 90% of its assets and over the amount of qualifying assets. And based on the shortfall, there's a monthly penalty that the fund is required to pay. But there's no guidance which says that the Qualified Opportunity Fund designation would be terminated and that the deferred gains would become taxable.
But you don't want to find out.
No.
Right. And I suspect that in an egregious case in which a fund was blatantly ignoring the rules, which was privately held, the IRS could very easily come in and say, this is really, it was never a Qualified Opportunity Fund, so all these deferred gains are now taxable. So, right, these rules really need to be adhered to. If a fund wouldn't be holding a large amount of cash and was just buying real estate, for which the renovation was going to be funded through debt, in that case, a decision can be made to forego the subsidiary partnership structure because it really doesn't give you a lot of benefit. True, a Qualified Opportunity Zone business only needs 70% of the assets in the zone, but if you're buying rental real estate, you know your assets in the zone, so that test isn't necessarily relevant. The ability for partners to elect after 10 years to exclude the gain from the sale at the fund level only applies to gains at the fund. So if the fund holds the assets, it's very easy for the fund to sell the asset. If it's done within a Qualified Opportunity Zone business, that business would probably have to be liquidated into the fund, and then the fund sells the asset. So it's not really that unattractive, but it just simplifies the structure.
So in other words, what you're saying is, if I know I'm using the qualified investment solely for my equity, my original acquisition of the building, for example, and that, you know, I'm using debt to make up the rest of the acquisition and debt to do all of the renovation work, I don't need a two-tiered structure.
That's correct. Also, as we talked about earlier, a Qualified Opportunity Fund can hold cash for 12 months on the sale of assets. It's only the fund which can hold the cash from the sale of the assets, not the business. So the Qualified Opportunity Zone business flipped a building, that cash can't be held for 12 months. So again, in that case, presumably the Qualified Opportunity Zone business would need to be liquidated into the fund, and then the fund would need to sell the asset. Not a difficult thing to do, but not something that you need to do if there's no reason to have that Qualified Opportunity Zone subsidiary entity in the first place.
So Steve, let me give you a situation. If I've got you know, two groups of investors and they don't want to be in the same fund, they want to do each have their own separate opportunity fund, but they're going to do one building. They're going to develop a building together. I essentially have two choices, right? I can either set up a Qualified Opportunity Zone business and have the two funds invest in it. Could I also do it in a way where I have each opportunity fund be a tenant in common owner? In other words, I have a TIC interest in that building?
I've seen nothing in the guidance that would prevent a TIC. A TIC could be harder to manage though, because each TIC would have to ensure they had met the test. It's a lot easier to ensure they are meeting the test if it's owned by the same legal entity.
Yeah, so in other words, if I'm going to do that, I'm better off with the Opportunity Zone business because I run the risk that the IRS could say my TICs are really a de facto partnership and I haven't done the right certifications and the right work at the Opportunity Zone business level to make sure I comply?
That's correct. And I mean, I'm seeing cases in which there's a Qualified Opportunity Zone business and its partners could be 2 or 3 Qualified Opportunity Zone funds. So in other words, different groups are pulling capital, forming an Opportunity Zone fund, and those funds are investing in a Qualified Opportunity Zone business. A Qualified Opportunity Zone fund can also find 2 or 3 businesses to invest in, and each one would be a subsidiary partnership. Key takeaways, the tax benefits of investing in these funds are attractive. There's a deferral of capital gain and the elimination of gain on the ultimate sale after 10 years. Through the expansion of the working capital safe harbor and the ability for partners of flow-through entities to eliminate capital gains flowing through, the proposed regs have largely been very taxpayer friendly. As with anything, these investments have to be a good business decision. You never let the tax tail wag the dog. There's no point in getting into these funds if you think it doesn't work from a business perspective, because if the investment isn't a good investment, the tax benefits don't really matter. One thing to keep in mind, when the deferred capital gains become taxable in 2026, the money is going to be tied up in the fund, so the investor would need cash from another source to pay the tax. This is a long-term 10-year commitment. The rules are not designed to constantly flip these things around. And keep in mind, any sales that occur in less than 10 years are taxable. There's no deferral, even if that sale is done by the fund. Another thing to keep in mind, in order to exclude the gain, the asset has to be sold by December 31st, 2047. That was indicated in the first set of proposed regs. People are expecting that date to be extended or modified. Nothing changed in the second set. So these investments have to be gone by December 31st, 2047.
Should I check with you in 2046 and make sure how we're doing on that?
Sure, absolutely.
All right, thanks.
Steve, we have a number of questions that we want to address. One of the multiple questions is people are really interested in the slides and want to know if they'll be able to get a copy of it. And we will be emailing all the participants, and they'll be able to download the slides from that email. So everybody will have access to that. Question on tenant improvements. Do they qualify under the 50% improvement rules?
In other words, on leased property?
Well, the question we have here is, do tenant improvements qualify under the 50% improvement rules?
I think the question is, if I buy a building and all I do are tenant improvements inside the building, do those tenant improvements, I'm leasing an office building, do those tenant improvements qualify as my qualified improvement to the building?
I think as long as you doubled your investment in the building, even if it was only tenant improvements, that would be okay. But you'd have to double your investment in the building.
Mm-hmm. And if you contribute property to a grantor trust, that does not trigger a gain. What about to a non-grantor trust?
That would trigger the gain.
Another question we have is, if a qualified service business purchases a building that has been depreciated in the last 5 years and has a cost segregation study performed, does the personal property need to be 50% improved?
To meet the substantial improvement test, all the tangible property would need to be doubled. The investment would need to be doubled.
Mm-hmm. Let's see. We have a question. I want to make sure that we meet our time commitments, but a number of people are asking, is there any kind of target gain that somebody should consider to be interested? In other words, if they have a large $500,000 capital gain, they would certainly be a candidate. But what if they have a gain of only like $25,000? Does it still make sense to do something?
It probably wouldn't make sense to start a proprietary fund if you're only trying to defer $25,000, unless it's a deal you already wanted to do. Even then, it may not be worth it because there's certain requirements that you have to meet. If somebody wants to invest $25,000, they're probably better off going into a third-party proprietary fund, as long as they can find one for which $25,000 met the minimum investment requirement.
I think Morgan Stanley, for one, has such a fund, and I know that some of the other brokerage houses are entertaining being competitive in that area. We have a question here that if using the two-tiered structure, can the qualified opportunity zone property be sold and then reinvested without causing the loss of the gain elimination?
Only if the 10-year holding requirement is met. If the fund sells the property in under 10 years, the gain would generally be taxable to the investors. And the 10-year holding requirement isn't the holding requirement of the building, it's a holding requirement of the partnership interest. So if I've held my partnership interest for 7 years, but the fund is an existing fund and has held the building for 15, because I only held my interest for 7 years, that gain would be taxable to me.
Steve, thank you for this informative presentation. We are available for questions and for consulting on this valuable new opportunity, no pun intended, and we appreciate all our listeners who phoned in, who have observed it today and have asked questions.